Hey guys, welcome back to the channel. Recently, I have received a lot of requests from my subscribers to make a complete course on smart money concepts from the very basic to the advanced level. So, I posted a community poll to see if the majority were actually interested. And the poll results were extremely positive. About 90% of all who participated wanted to learn smart money concept. So here I am, thrilled to present you with this new video course on smart money concept. The course is designed in an orderly manner to provide you with the most comprehensive understanding of the principles and strategies associated with smart money concepts. I'll be taking a very conventional approach, assuming that all of you are complete beginners to this topic. Keeping that in perspective, I will discuss the main concepts in greater detail, which is actually essential to build a solid foundation so that we can have a good understanding about the strategies that we can implement as a trader. This will in turn enable us to plan our proper entries, stop loss, and targets, thereby generating high reward to risk trades, which is the highlight of this entire SMC concept. I'm not even joking when I say high reward to risk ratio. We are literally talking about 10 is to 1 or 20 is to 1 or sometimes even a whopping 40 is to 1 reward to risk ratio, which is absolutely insane. And that tells you how powerful these concepts are. By now, I have mentioned smart money concepts numerous times. But what exactly are smart money concepts? I don't want to bore you by giving the same old answer that these are techniques or methods used by large institutions, hedge funds, banks, etc., who are referred to as smart money due to the reason that they make smart decisions in the market, and most of these concepts are purposefully kept away from the reach of uninformed retail traders. But my outlook on smart money concepts is different. I like to view them as traps set by the big institutions to use retail orders, usually the stop loss orders, to generate enough liquidity so as to buy at discount and sell at premiums. Think of these methods as manipulations or stop loss hunting or liquidity grabbing or simply the inducement of retail traders to enter into wrong trades at the wrong time or wrong locations. I know these terms are a little over your head, but fear not, because we are going to deal with all these terms in the upcoming episodes, and I guarantee that you will love it. A lot of research, learning, preparation, and hard work has been put into making a very relevant course, and that too absolutely free of cost. I doubt if anyone would take all the pain to make genuine content for my retail trader brothers. So I request you to wholeheartedly like this video and support the upcoming videos also, and share all the episodes with all those who are willing to learn and improve their trading but don't have the money or means to do so. Also make sure to subscribe to this channel because it's free, and also enable the bell icon so that you will receive notifications when I upload the new episodes. So in this video, I would like to give an idea about the course structure and why you should learn these concepts. Then I will answer the evergreen questions like which is the best market to trade SMC techniques? Will it work in the Indian markets? Which is the best time frame to analyze and trade smart money concepts? Or should we use the multi-time frame analysis approach? But before all that, I would like to take this opportunity to thank Wyckoff theory developed by Mr. Robert Wyckoff during the early 20th century. So you can think how old these concepts are. Actually, the whole Wyckoff method is based on the premise that the market is manipulated by a small group of traders, or so-called the smart money, who have the ability to influence market movements. These smart traders or institutions use their knowledge and resources, which include data about retailer orders and retailer behavior, and they use this information to accumulate or distribute assets before the public is even aware of their intentions. Or in simple layman terms, they manipulate the market to trap retailer liquidity. Smart money concepts or institutional concepts theory is improved by the works of Inner Circle Trader, Tom Williams, Steve Morrow, and a few others. Every now and then, these concepts are given a new look and some flashy names, but the concept still remains the same. Think of it like companies introducing their old product in a new exciting packaging, inducing you to buy these courses. So I urge you not to spend a lot of money on these expensive courses, because these series of episodes will be more than sufficient to understand the concepts and strategies. But I have an advice. I would like you to watch my courses on price action and supply and demand. The reason why I'm suggesting this is because smart money concepts, price action, and supply and demand theory are all interconnected and have a lot of similarities. It is just the terminology that changes. Most of the underlying ideas are the same. The crux of smart money concept is simply this. Markets are manipulated by big institutions and funds, and they use the liquidity of retail traders against them. Now, coming to the second question, why do you as a retail trader need to learn about these concepts? And is it necessary? Actually, I can give an answer to this question in a single sentence. It is just that if you don't know where the liquidity is, then you are the liquidity. Every move in the market is in some way a trap set for the uninformed retail traders. Most of the retail traders blindly follow certain strategies, patterns, and some even call themselves breakout traders while others identify themselves as reversal traders and so on. But until and unless you don't understand how and why a price move was triggered, you will remain as a tiny fish in the ocean being hunted over and over again by the big institution or the smart money. So having a good grab of these techniques can give you a boost to your understanding on how to track the liquidity and how to capitalize on it just like the institutions. You will definitely start thinking differently and view charts with a broader perspective. Because I strongly believe that every move or even each candle formed in the market has a meaning or a logic behind it. If learned and implemented in the right manner, these concepts will definitely take you to the next level. Now, another doubt that most of you might have will be regarding the type of markets in which these concepts can be applied. To be frank, these concepts can be applied on all those markets which have ample liquidity. So, liquidity in simple terms is the ease of buying and selling of an asset without much slippages, meaning that there are enough buyers and sellers available for the smooth transaction of assets. Now, the more difficult it becomes to buy or sell an asset, the asset is said to be less liquid. Now, how do you know if the market or chart you are looking at is liquid or not? Now, there are a few ways to find this out. The most simple method is to look for trading volumes. As you may all know, trading volume refers to the number of shares traded in a particular time frame or period. It could be for 15 minutes or 1 hour or a day or a week. A high trading volume indicates that there is a lot of interest in the stock or an asset and it is highly liquid. With this, we can say that most indices are highly liquid. So to answer your question, these concepts will work well in indices like Nifty, Bank Nifty, etc. But when it comes to stocks, you will have to compare the volume of a stock with its competitors to get an idea. And along with that, we also need to look at the bid-ask spread and the market capitalization of the stock. In simple terms, the market capitalization of a stock is the total value of all outstanding shares. So a higher market capitalization generally indicates a more liquid stock as there are more shares available for trading. On the other hand, the bid-ask spread is the difference between the highest price that a buyer is willing to pay for a stock, or it is called the bid price, and the lowest price that a seller is willing to accept, or the ask price. So a narrow bid-ask spread indicates that the stock is highly liquid as there is a lot of activity in the market and the buyers and sellers are very close in their pricing. But if the bid-ask spread is wide, then the stock is less liquid or there is less activity taking place. So if you are trading in the Indian markets, I recommend you stick with the top Nifty 50 stocks or maybe just select the top 10 stocks that you like from the Nifty 50 range of stocks from different sectors. And if you are a beginner, try your best to avoid mid caps and small caps because the price action may not always be that smooth and sometimes things may not work out. But the best markets to trade smart money concepts are Forex and crypto markets, which are open for almost the entire week, thereby providing a much smoother price action. But this does not mean that all Forex pairs and cryptocurrencies are equally liquid. There is Euro USD, USD JPY, etc., which are highly liquid currency pairs, and cryptos like Bitcoin, Ethereum, etc. are highly liquid. On the other hand, there are other currency pairs like CAD-CHF or PLN JPY, or even cryptos like KuCoin or Gatecoin, etc., which are not liquid. So in short, you can use the smart money concepts to trade Forex markets, crypto markets, indices, and stocks, all of which having high liquidity. Now moving on to the second most popular question, which time frame should I choose to trade smart money concepts? To be absolutely frank, we need to follow a top-down approach. That is, we need to start our analysis from the higher time frames or the trend time frames to identify the larger market trend and mark the areas of values, and then move down to an intermediate time frame to spot nested areas of interest for refining our higher time frame analysis, and also to identify the market liquidity, and finally move down to a lower time frame to take a proper entry, set a stop loss, and place a suitable target. Now, SMC technique will work for all trading styles, whether you are a swing trader or intraday trader or BTST trader. It doesn't matter what your trading style is. I have already made a detailed video on how to select the proper set of time frames based on your trading style that you follow. So you can watch that video to know more about multi-time frame analysis. Now finally, let's look at how the entire course is structured. As I have mentioned earlier, we will go in depth into the most important smart money concepts as shown on the screen. Once you become familiar with all these terms and their meanings, we will discuss the application side by learning how to use these concepts for trading in the live markets. That is, how to implement these SMC strategies. We will also talk about the risk management part, where we will learn the entry stop loss combined with the proper exits to plan a high probability, high reward to risk trade. Last but not the least, I will also discuss an indicator that will make things very easy for you so that you don't have to analyze each chart from scratch. With this indicator, you just need to cross-check the validity of the generated SMC signals for trading.
Sorry to interrupt, but this could be important for you. Have you been in a situation where you want to invest your precious savings in the stock market, but there are just too many stocks to choose from and too many gurus giving stock tips? It's risky, and you don't want to take the hassle of reviewing the fundamentals and sweating over the company's performance. Then there are the same old mutual funds. No doubt, mutual funds are great investment instruments, but they are mostly vanilla and less transparent. Introducing small cases. A small case is a ready-made basket of stocks or ETFs which reflect an idea, theme, or strategy. It is just like a supermarket where everything is available, everything is clearly labeled with the right variety and options. Now let's look at a scenario. What, according to you, is the future of the Indian economy? Well, to begin with, the Indian economy is going good. According to some reports, in the coming next 15 years, 45 crore people will be joining the middle class, which is actually huge. This means more buying power. Now, if there is money, then the demand will also increase. So now, what do you think these people will do with the income they're left with after paying for rent and food, luxuries, branded products, travel, and more? With the great Indian middle-class small case, you can invest in all those companies who will benefit from the growing consumer demand. Through just a single product, you can invest in a ready-made portfolio of stocks. Well, that all sounds very great, but then who puts together these portfolios? Small cases are created by SEBI-registered professionals who have an idea or strategy. These guys do all the hard work of selecting stocks and deciding how much money is allocated to each stock. Remember, there are many such small cases and enough options for everyone. What if I need to know more about small cases, like their past performances, their stock selection, or things like that? Small cases present all the necessary information for you to make a decision. You can look at the CAGR, today's change and risk profile. You can see all the stocks and weights and see the criteria behind picking of these stocks, measure past performances of lump sum and SIP. You can also see the news related to these stocks. All you have to do is click invest. And the best thing, when you invest in small cases, you only pay when you transact. There are no expense ratios. It means that the cost is low and investing is easy. Moreover, your stocks and ETFs will show up in your Demat account. So what are you guys waiting for? Stop picking stocks that you don't understand. Instead, invest in ideas that you believe in through small cases. The link is in the description. Happy investing. Now let's get back to the video.
Let's say you are a curious kid and you ask me to explain what smart money concepts are in a single sentence. Then I would say smart money concepts are a few methods of identifying, planning, and executing trades on the basis of where the majority of market orders are and what the major market direction is. So, in a nutshell, it all comes down to figuring out the market direction and where the major liquidity is there for taking. So, as you might have already guessed, the initial step is to identify the market behavior at a particular time period. Or to be more precise, we are interested in identification of a proper market structure so that we can plan our trades based on the dominant market direction. So in this video, we are going to deal with the idea of market structure with respect to smart money concepts. Now, you may ask me, haven't we already discussed the concepts of market structure and market trends in the price action course? Actually, yes, we did. But when it comes to smart money concepts, market structure identification involves a lot more abbreviations, new terms, and stuff like BOS, chalk, strong highs, strong lows, weak highs, weak lows, etc. But the overall idea remains the same. I personally think that with smart money concepts, you will get to understand market structure and its working in a much greater detail. And in addition to this, we will also get a clarity on the major market structure and the minor or internal market structures. And we will also talk about the nature of pullbacks for both these structures. So let's get going right away. Now, you may be familiar with the fact that a liquid market or a stock or any asset goes through several market phases, majorly the accumulation phase, the markup phase, the distribution phase, and the markdown phase. Now, there can also be sub-phases like the reaccumulation or redistribution phases. But my point is that even though there are several phases of the market, the overall market structure boils down to three main stages or trends, namely the uptrend structure, the downtrend structure, and the sideways or range-bound market structure. Now, as you may already learned from the price action course, an uptrend is characterized by higher swing highs and higher swing lows, while downtrend forms when price forms lower highs and lower lows. And when it comes to sideways market, there is no clear trend or price action, or simply the price remains within a range. Now, this is a very basic way of understanding market structure and trends. But in this video, let's build on top of this basic idea. So in smart money concepts, we are mostly interested in trending price action when compared to sideways or range bound price action. But this does not mean that we can completely avoid sideways ranges. And it is not the right way to think about it. Because further forward in this course, we will definitely talk about how to deal with or trade on range price action. Meanwhile, let us now focus on the two main structures based on SMC technique. Now, these are the bullish market structure and the bearish market structure. So think of a bullish structure as an uptrend with many more constraints. And on the opposite, think of a bearish structure as a downtrend, but with a lot more constraints or factors to consider. First, let us take a look at a typical bullish market structure. And yes, you are right, we need to look for higher highs and higher lows. But market structure is not always that easy to identify. It is more complicated and challenging than we think. I personally believe that if you get this particular step right, then you will be able to get most of your trade analysis correctly. In fact, this is the step where most people make mistakes. So when you commit a mistake at the start of your analysis itself, then naturally the rest of the process will obviously amplify the initial mistake, and finally you will be left with a corrupted and incorrect analysis in hand. And guess what? All of this will result in a wrong trade at the wrong time and the wrong location, with you making huge losses. And at the end of the day, you will have no idea where things went wrong. So my request is that you strengthen your basics first. Now with that out of the way, let us understand a bullish market structure. See, as mentioned just now, market structure will not always be very easy to identify and mark. Sometimes it can be confusing and complicated. Take a look at this chart. At a single glance, can you determine the overall market structure? Well, most of you would not be able to. Actually, this is a bullish market structure. And why do you think you are not able to identify this? The simple reason is that your eyes are not trained to look for specific details. Let me explain this. Now, you might have learned that market moves in the form of waves, and during a trending move, there is an impulse move and a corrective move. This is true, and I don't have any problems with this idea. But what needs to be added in this context is that a market structure comprises of two structures. That is, there is a major structure and there is a minor or internal structure. And as the name suggests, the major structure is the dominant structure, or it is the major structure that determines the dominant player in the market. Now, the minor or internal structure is the less important structure that gets formed within the major structure. So, if you are planning to be an SMC trader, then you should train your eyes to spot these major market structures in comparison to the minor structures, because it is the major structure that majority of our trades will be concentrated on. Now, you may ask me which time frame we should look for the major structures. Now, we will get to this topic of time frames in a later on video, but for the time being, keep in mind that we have to look for the major structures on the higher time frames for our analysis. You can check out my detailed video on time frame selection to learn more about how to select proper time frames based on our trading styles. Moving on, let's learn how to map the major market structure and also discuss what the breakout structure and change of character is. Now, this is important because it helps you confirm the major swing points. That is, it lets you confirm the higher highs and the higher swing lows in a major bullish market structure from the minor swings, which actually behaves like noise in our analysis. Similarly, it can help to confirm the lower swing highs and the lower swing lows in a bearish market structure from the minor or internal structures. Now take a look at this. The market momentum is bullish. The market created a low and a high. Then the price made a retracement or a pullback. Then once again, the price moves higher and breaks and closes above the previous high. Now this is called a break of structure, or simply BOS, or spelled as BOS. It is also called as a continuation break as the price resumes in the major trend direction. So technically, a bullish break of structure happens when the price breaks and closes above the previous swing high or the higher high. Please do note that the price has to close above the previous swing high level for this to be considered as a valid break of structure. Just a liquidity sweep or simply a false breakout associated with a long wick does not qualify as a break of structure. In addition to this, only when a bullish break of structure happens, then only the higher swing low level is confirmed. And as you may know, a higher low is the lowest swing point, which is higher than the previous swing low level in a bullish trending market structure. Now, what happens after a bullish break of structure? How do we confirm a higher high? Now, listen to me carefully. Price rarely moves in a straight line. If you observe within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So once the price bounce or get rejected from a level, then normally it will target a previous short-term high or low before continuing in the same direction as the longer-term trend. And for some of you, this might be a very new concept. And by the way, this is called as an inducement, which is a very important topic in SMC. And we will discuss this concept in our upcoming episodes. And once we get used with all these small topics, we will combine all these concepts to finally understand what a true SMC structure looks like and how it works in a very practical manner. But for the time being, let us go ahead and understand how a higher high of a major bullish structure gets formed using a concept that most of us are already aware of. It is none other than pullbacks. So the price breaks the previous high and it moves higher, but it cannot go higher indefinitely. At some point, it has to come down, which we call as a corrective move. So we can say that a bullish market structure is a combination of bullish impulse moves and corrective pullbacks. Now you can ask me, do all these pullbacks or corrections matter? The answer is no. We are more interested in those deeper pullbacks. Now, how do we know if a pullback is deep enough? For this purpose, we can make use of the Fibonacci retracement tool. So a deeper pullback is a retracement that goes beyond the 38.2% to 50% or even lower Fibonacci levels without closing below the previous swing low or higher low levels. The reason why we require a deeper pullback is because there is a lot of liquidity available below these internal pullback levels. And for the market to make a meaningful move, it has to tap into these retailer orders and then use these orders as a fuel to move higher. This is a very simple explanation of a much complicated concept. I hope you guys have understood what I'm trying to explain. Anyways, once we have identified a deeper pullback using Fibonacci retracement tool, we can now mark the highest point after the previous break of structure as the higher level. And now once again, if the price moves higher and if it manages to break and close above the recent higher high formed, then again we have a bullish break of structure. And this step will confirm the higher low level, which is in fact the deepest pullback before the break of structure has happened. So in short, a new higher high is confirmed only after a deeper pullback has happened, which will actually sweep all the previous retailer liquidity below the internal or minor swing lows. And on the contrary, a new higher low is confirmed only when a valid bullish break of structure happens. Now what happens when the market fails to make a new higher high? That is, the break of structure fails, but instead the price breaks and close below the previous higher low level. So if you have watched my price action course carefully, then you know that this is the first sign of a change in the market structure from bullish to bearish. Or in other words, we can say that this is the start of a new trend reversal. And in smart money terms, this shift in the market structure is called as a change of character or simply chalk. But do keep in mind that the price has to break and close below the previous higher low for the chalk to get confirmed. This is very important as many traders make mistake in this part, as just a liquidity sweep or a false breakout with a deep wick projecting below the higher low does not qualify. Once a change of character takes place, we will now focus our analysis towards the formation of either a bearish market structure or a sideways market structure. We should consider the possibility of both these structures until and unless we get a solid confirmation for the continuation of the bearish market structure. Let me explain this in greater detail. We know that during a downtrend or a bearish market structure, we expect the price to form lower swing highs and lower swing lows. So if you want to be an SMC trader, you have to train your eyes to find these important levels. But trust me, it is not as easy as you think. Because in most trading textbooks, we will find a very simple and straightforward method of identifying market structures. But in real market scenario, it is much more complex. So listen to me carefully. In order to confirm a lower low in comparison to the previous swing low, the price has to do a pullback. Not just any pullback, but a deeper pullback, taking out the liquidity of the previous internal swing high levels. Now you can identify if it is a deeper pullback or not by using a simple Fibonacci retracement tool and check if the pullback is over 38.2% or 50% or even higher levels. But as long as it does not break and close above the previous major swing high level, we are okay with it. Now what is the significance, or maybe what is the logic behind wanting a deeper pullback? Now the logic is quite simple, and it is associated with the retailer mentality. So as a retailer, what will you do when you spot a breakout or a breakdown? Obviously, you will take a trade in the direction of the market break, right? Now, where will you place your stop loss? Quite clearly, you will place it beyond the breakout level. So in case when a retailer sees a bullish breakout structure, most probably he will place his stop loss below the previous minor swing low level. And if we spot a bearish change of character, he will take a short position and he will place the stop loss just above the previous minor swing high level, right? Clearly, these swing levels just before a breakout or a breakdown, or in other words, these swing levels just before a break of structure or a change of character have a lot of stop loss orders available. These stop loss orders are in fact retailer liquidity, which the smart money is so keen to exploit. And these clusters of stop loss orders helps the smart money to buy low and sell high. Now coming to the reason why these deeper pullbacks are important. It is quite evident that these deeper pullbacks are actually searching for retailer liquidity, and once the liquidity is absorbed, the market usually tends to continue strongly in the major trend direction. So we have to look for a deeper pullback after a change of character has taken place, so as to confirm if the low formed is actually a lower low or not. Don't worry if you have not understood this concept completely. You can either watch this concept multiple times, and still if the doubt persists, you can wait for the upcoming episodes where I will talk about inducements, order blocks, etc., so that you will get a deeper understanding on the smart money concept structure mapping. Now moving on, after the deeper pullback, taking out the retailer liquidity and confirming a lower low, the price moves lower and it breaks and closes below the recent lower low level. This is called a bearish breakout structure, or simply BOS. I'm stressing the point that the price needs to break and close below the previous low level to confirm a valid breakout structure. Just a liquidity sweep or a false breakout with a deep wick projecting below the lower low level won't count as a valid breakout structure. Now, only when a valid breakout structure happens can we actually confirm the lower high level. So long story short, a lower swing high is confirmed only when there is a valid bearish breakout structure. And on top of that, the lower swing high is the highest point before the BOS and the previous lower low level. And all the other swing highs are just the internal or minor structures, and we don't have to give much importance to these. As an SMC trader, the major structure matters to us the most, and we conduct the analysis for our major structure on our higher time frames to get the best possible results, because in the lower time frames, charts are more random and noisy. Now once again, the price has to search for liquidity in these intermediate or internal swing highs, and in doing so, it forms a deep pullback which sweeps the liquidity in those levels and then moves lower. Now once the liquidity is absorbed by a deeper pullback, which can be measured using a Fibonacci retracement tool, we can confirm the new lower low level. Then again, the price has to move lower and break and close below the new lower low formed to confirm a valid breakout structure, and in turn, the highest point before the BOS and lower low will be marked as the new lower high level, and this process continues until the price fails to break and close below the previous lower low level, and instead it breaks and closes above the previous lower swing high level. Now what does this indicate? This actually signals a change in the sentiment, or it can be thought of as the first indication of a reversal. That is, the trend might change from bearish to bullish. So this shift in the market structure is called as a change of character. So now we have to change our perspective and we have to look for a bullish structure or a sideways market structure. And by now, you might already be familiar as to how to identify a bullish market structure, right? But hey, I haven't talked about the sideways market structure, right? But you may already be familiar with the accumulation or distribution phases from my price action video. These are phases where the market takes a break or where the big institutions start building their position, which is actually represented by the accumulation phases, or where they start selling their holdings, which is called as the distribution phase. Anyways, the sideways market structure can be any of them. Think of it as market taking a pause or a breather. And only when the price breaks and close above or below the constraints of this phase are we really interested in making a move. So as an SMC trader or a price action trader, it is always ideal to wait out the sideways market and focus more on the trending market phases for your trades. Now, before I finish this episode, I have to discuss a few more terms like strong highs and strong lows, weak highs and weak lows, etc. Now, these are just additional information which is built on top of what we have already learned in this video, and it's nothing new. So, a weak high or a weak low refers to those swing highs and lows which have a greater possibility of getting swept. So, for example, a higher high is considered as a weak high as it has a good possibility of getting taken out by a bullish breakout structure. And similarly, a higher low is considered as a weak low as there is a good chance that a change of character can take out this higher low. On a same note, during a bearish market structure, a lower low is marked as a weak low as there is a good chance that it can be taken out by a bearish breakout structure. And similarly, a lower high is considered as a weak high as it can be easily taken out by a change of character. So in short, a weak low or a weak high has a greater chance of getting taken out by the market. Contrary to this, strong highs and strong lows are those price levels which are not easily taken down by the market. So typical examples of this are the higher highs just before a change of character, meaning that the market was not able to take out the higher high level, which makes it an important level for future price analysis, as it could play the role of a potential resistance level in the future. Similarly, a lower low just before a change of character is considered as a strong low for future analysis because the market was not able to take out this level, and it can act as a meaningful support level in the future. Now, other than these, there are equal highs and equal lows, and as the name suggests, they have same high or low levels. Now, we will understand the significance of all these as we move along this course. But I think this is enough for this particular video. And after a few more episodes, we will revisit this topic once again. But then we will discuss the topic completely using relevant charts, be it Forex charts or Nifty or Bank Nifty charts. Anyways, I would like to end this video by mentioning that market structure makes up the backbone of the market, and it is essential in understanding if you want to be able to read the market more precisely and clearly so as to be able to trade in it successfully. In the previous episode, we have understood about the market structure mapping in great detail. In this video, I would like to introduce you to a completely new topic. It is known in different names in SMC, be it fair value gaps, imbalance, inefficiency, etc. But the overall concept remains the same. What you need to keep in mind is that such imbalances in the market happens due to irregular or disproportionate price movements. These price movements may deviate from what is considered normal or expected based on historical price patterns, fundamental analysis, or technical indicators. Such inefficiencies or imbalances can create potential trading opportunities for both investors and traders. But imbalances in price behavior can take different forms. Just think about it. Could be in the form of gaps, volume imbalances, spikes, lack of liquidity, displacement, etc. Now, I will try to explain each one very briefly to get a general idea of what is what. Let's start with gaps. Price gaps occur when the opening price of a candle is significantly different from the previous candle's closing price. So, a gap has a complete absence of trading activity between two candles. Now, these gaps can be caused by various factors, such as overnight news, earnings reports, or other market moving events. And gaps can be of different types. It can be breakaway gaps, runaway gaps, exhaustion gaps, and professional gaps. Depending on the type of gap, you can choose to adopt a particular strategy to capitalize on the imbalance. I have already made a detailed video on gaps and how to trade them in my complete price action course. You can check that out to learn more. Next up is volume imbalances. A volume imbalance is a gap between the closing and opening price of two candles and the difference in between. A volume imbalance, in fact, has a trading activity happening, or there is an overlap between the high and low prices when compared to a price gap. Now, a quick example of a volume imbalance would be from this closing price to this opening price, and also we have a gap. However, the price did manage to trade through these areas, so it is indeed a volume imbalance and not really a price gap. Moving on, price spikes refer to sudden and sharp movements in a security's price, often resulting from an unexpected event or a large surge in trading volume. Now, these spikes can be caused by different factors such as market orders, stop loss triggers, or algorithm trading activity. Now, in some cases, low trading volume and liquidity in a particular stock can lead to inefficiencies, as it may result in a wider bid-ask spread and difficulty in executing trades at desired prices. So traders need to be cautious when dealing with illiquid stocks, as it can be challenging to enter and exit their positions without causing significant price impacts. Now, all these are in some form or the other a type of imbalance in the market. But when it comes to smart money concepts, we are only concerned about the imbalances caused due to displacements. So displacement, in short, is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single candlestick or a group of candles that are all positioned in the same direction. Now, these candles typically have large real bodies with very short wicks, which suggests that there is a very little disagreement between buyers and sellers. Or, in other words, only one party has a clear dominance over the other. Most often, a displacement will occur just after a liquidity level has been breached, where there are clusters of orders, and this will often result in the creation of both a fair value gap and a market structure shift. Now, we have already discussed market structure mapping and terms like BOS, chalk, etc. in the first episode. So make sure you have a proper knowledge of the same. But right now, what we are concerned about are fair value gaps or inefficiencies or simply imbalances. So after the price reaches a particular liquidity level where large numbers of orders are accumulated, and when price reverses after absorbing the liquidity from this area, often what will come next is displacement. So these fair value gaps are usually created within these displacement moves, which means that these are instances in which we can spot inefficiencies or imbalances in the market. I have talked about liquidity levels where most of the orders are accumulated. But how to identify these levels? There is a simple rule to spot these areas. So, the last bearish candle or selling momentum before an up move is referred to as a bullish order block, where a large number of buy orders are assumed to be located. Similarly, the last bullish candle or the last buying momentum before a down move is referred to as a bearish order block, where a large number of sell orders are assumed to be clustered. Just keep this in mind and don't stress a lot because we will learn all this in great detail in the upcoming episodes. Now you can ask me, why is an imbalance or fair value gap for that matter considered as an inefficiency? The reason is simple and straightforward. When price moves strongly in one direction, and that too by means of large-bodied candles, there is a clear discrimination between the buyers and sellers. Let me explain. Imbalance, as the name suggests, is an area of unequal market moves where there are only buyers or only sellers which exist in the market. The reason we call this an imbalance is not only because it is an imbalance between buyers and sellers, because there is literally an imbalance in the market. Trading volume is tilted either towards the bid or ask side too quickly, so there are still a lot of unexecuted orders in the market. So if we have an impulsive move to the upside, it is because there are no sellers to absorb the buying pressure of the bulls. This means that there is no resistance from sellers to stop the buyers from pushing the price up rapidly. On the other hand, if we have an impulsive move to the downside, it means there are no buyers to absorb the selling pressure of the bears. This means that there is no resistance from buyers to stop the sellers from pushing the price down rapidly. Simply put, imbalances occurs when there are many orders of the same type, be it buy, sell or limit orders, and also a lack of liquidity or counter orders in the market. For example, if there are many more buyers of a stock than sellers, then the balance can tilt in the favor of buyers. And on the chart, this imbalance looked like a price gap within which only a part of the volume has been traded. This is an unhealthy price action because it shows the disequilibrium between buyers and sellers. So an imbalance means unfair price action where the market will almost always come back to fill. Another thing to note is that the wicks do not fill each other. And if they do, then it is healthy price action or efficient price action and not really an imbalance. So to put it simply, market inefficiency occurs when the wicks are separated by a distance or a gap and they do not meet. While an efficient market, on the other hand, is one in which the wicks do not have a gap between them and they actually meet. This brings us to the next important point. How to identify or spot an imbalance or a fair value gap within a particular displacement move. To be absolutely clear, an imbalance can be defined as an imbalance between buyers and sellers. So a bullish imbalance has more buyers behind it, and obviously a bearish imbalance has more sellers behind it. So when you see an impulsive move to the upside or downside in the market with no wicks overlapping full-bodied candles, this is where imbalance in the market are formed. These can happen on all time frames. Now, when looking for an imbalance in the market, simply look for any candle which has a full real body and look for the part of this candle that is not overlapped by the previous and next candle's wick. This signifies an imbalance in the market because there were only a few transactions going on between buyers and sellers. We can clearly say that one party has overpowered the other depending on the direction of the price. Now, if you think about it, wicks usually represent price oscillating up and down within the time it takes to print an entire candle, showing that the price is efficient because there were continuous transactions happening between buyers and sellers. So it shows us that price is giving both buyers and sellers a fair chance at accessing the liquidity. So when the bigs meet, it provides the buyers and sellers an access to get into the market and profit on the price move. But on the contrary, when you see a full-bodied candle with no wicks overlapping it, it is obvious that you have identified a clear imbalance in price. This may seem very complicated and over the roof, so let me break this down further and help you understand it better. Now, a very simple method to keep in mind is to think of a fair value gap as a 3 candlestick pattern where the first candle's low does not overlap with the third candle's high in case of a down move, or where the first candle's high does not overlap with the third candle's low in case of an up move, with the condition that the middle candle has to be a large bodied candle with little or no wicks. But there can be some exceptions to this rule, which we will look at. But first, let's take a deep dive into this concept. As I have mentioned just now, these imbalances on price chart are visualized by a 3 candlestick sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. Now take a look at this example. The middle candle is a large bearish candle with little or no wicks. Now number the candles as 1, 2 and 3 from left to right. Then consider the first candle's low and mark a horizontal line out, and do the same for the third candle's high and extend out an horizontal line. You can notice that there is a clear gap between the wicks on the first candle and the third candle, and the wicks do not meet or the high does not overlap with the low. Therefore, this can be identified as an imbalance or an inefficient price action or simply a fair value gap. Now consider another example. Here the middle candle is a large bullish candle with little or no wicks. Now number the candles as 1, 2, 3 from left towards right. Then extend a horizontal line from the first candlestick high and do the same from the third candlestick's low. And you can clearly notice that the high and low wicks do not overlap with one another. So we can say this price action is inefficient or not healthy. So this is a fair value gap. Now let's take a look at some of the tricky situations which you could encounter in the charts. On some occasions, you will not be able to apply this rule directly, and you might need to focus on some more important factors before plotting a fair value gap. Observe this over here and tell me how will you mark the imbalances in this case. So if you look at this diagram, this candle here is our last bullish candle or the last buying momentum before the price drop. So most of you will mark this bearish candle's low, which formed after the last bullish candle, as number 1. And some people might even mark the bullish candle's low as number 1 and then mark the third candle's high. Now in either case, this is not a valid imbalance. And why is it so? If you look at the left side, there is a bearish candle before this up move, and you will notice that the high and low of this bearish candle is protected, meaning that the candle's high and low are not broken by the up move. So if the market creates anything between the high and low of this bearish candle, all those moves are considered as internal moves only. So in such scenarios, first of all, you have to check if the previous candle's highs and lows are broken or not. Then only you have to number the candles as 1, 2 and 3. So here, this bearish candle has to be numbered 1 and this candle's low is to be marked or extended using a horizontal line. The next candle which has broken the bearish candle low is our second candle, and finally, we will also mark the high of the third candle. Now this becomes our valid imbalance, which the market might return to fill or absorb. So keep in mind that internal price moves are not to be considered while marking proper imbalances. Now a lot of people will wait for the price to fill this particular imbalance and they will look for short trading entries. But this is not a valid imbalance. This would have been a valid imbalance if the market would have broken this bearish candle's low. So now the bearish candle is no longer considered. Now when you mark the imbalance, you can consider the bullish candle's low and number it as 1. But the next bearish candle is not taken into account because it is an inside candle which was unable to break the highs and lows of the bullish candle. So our second candle in this case would be this bearish candle which has broken the low of the bullish candle, and then the third candle high is also marked, and the difference will become our imbalance. Now there can be another scenario when the high of the last bullish candle has been broken. Now how will you mark the imbalance in this case? So here, this bearish candle is no longer an inside candle, and thus we can number it as 1 and mark its low, and subsequently we can number the other candles as 2 and 3 and mark the high of the third candle, and thereby we can observe the imbalance. I hope you guys have understood all these different scenarios. Now, I want you to mark the imbalances for these 3 scenarios on your own. Just pause the video and do it by yourself. The answer will appear on the screen after 5 seconds. So try it right away. So now that you have understood what a fair value gap look like, let's also make sure what it does not look like. Like before, extend a horizontal line from the first candle's low and another line from the third candle high to see if there is a gap. When dragging the high and low across, you can see that they overlap. This means that the low from the first candle is lower than the high from the third candle. So there is no gap or inefficiency there. And thus this is not a fair value gap. Similarly over here, if we were to extend the first candle's high using a line and also extend a line from the third candle's low, you can see that there is an overlap between the first candle's high and the third candle's low, meaning there is no imbalance or fair value gap. So now just to clarify, a gap between the first candle's low and the third candle's high, or the first candle's high or the third candle's low, is what creates a fair value gap. Now I want you to find such imbalances or fair value gaps on different charts and mark them on your own by this simple method. The next thing we are going to look at are CBs and BCs. These are nothing new. It's just the same concept in a new name and packaging just to induce curiosity. So a CB stands for a sell side imbalance and buy side inefficiency. What does this mean? It means that the sell side was offered but the buy side wasn't. So it is inefficient. Or simply put, it represents a bearish fair value gap where the bears have overpowered the bulls. It is also known as undervalued fair value gap. What it means is that the price of the asset is lower than its fair value gap. In this case, the price might increase in the future to balance this inefficiency in price. Now, a BC stands for buy side imbalance and sell side inefficiency. This means that the buy side was offered, but the sell side wasn't offered. So it is inefficient, or it represents a bullish fair value gap where the bulls have overpowered the bears. It is also known as overvalued fair value gap. What this means is that the price of the asset is higher than its fair value gap. Now in this case, the price might decrease in the future to balance this inefficiency. So if we look at this price action right here, we have a bearish fair value gap where the sell side is offered, but the buy side is inefficient. So this creates a CB. Now, if you look over to the right, you can see that the price has made a bullish fair value gap or a BC because it offered the buy side but not the sell side. And that's all about BC and CB, and I hope that clarifies some things for you guys. Now, another relevant question worth asking is, why do market imbalances occur? The emergence of persistent price imbalances in one direction after long periods of stable or efficient pricing indicates that institutions are accumulating positions. Now, these institutions can be funds, banks, and other financial institutions that we call smart money. But do keep in mind that the market is influenced not only by institutions, but also by market makers, investors, and traders with large capital. For example, smart money can place many orders and then modify or cancel them to bring the market back to an equilibrium state. These market makers, traders, and investors can oppose each other, and they can also act in the same direction. In most occasions, imbalances in the market can occur after the release of an economic or geopolitical news. The reasons can vary on whether you're dealing in forex or in other markets. It could be the publication of financial statement. For example, a very positive quarterly report can lead to an imbalance towards buyers. Similarly, it can be corporate announcement of bankruptcy, management changes, takeovers, business purchases, etc. It could also be governmental and regulatory actions, interest rate changes, etc., which could contribute to the imbalance. It could even be political problems, natural disasters, etc. Now, since you have understood what a fair value gap or imbalance is, now you can ask me, how is it useful for traders like you and me? Now, as mentioned earlier, imbalances in the market can be viewed as inefficiency in price behavior, telling us that maybe banks or big financial institutions are involved in the aggressive movements of prices that we are seeing. Again, if you think about it, most impulsive moves and imbalances in the market happen as a result of there being no liquidity in the form of counter orders to stop the price from being met with resistance and thereby slowing down. Now, if you consider an efficient market, we get to see the price trade within a range of fair value for that particular asset, where the sellers will sell when they perceive that the price of the asset is high or the price is trading at a premium, and the buyers will buy when they perceive that the price of the asset is low or is trading at a discount. This is not the case of an inefficient market. The big institutions will create a high momentum move and an imbalance in the market that is much like a gap in price. In most cases, this price manipulation can be a part of institutions' plan to generate liquidity to buy low and sell high, and therefore we may see the price coming back to fill that imbalance or close the price gap before pushing back into the same direction that the price made the impulse move from. And now, to answer the question, how can we as traders benefit from such imbalances? Imbalance is a type of trading opportunity for both intraday and swing traders. In trading, imbalances are used to identify zones of interest. We will talk about these zones of interest, which is more commonly known as order blocks, in the upcoming episodes. The zone from which the imbalance originated is characterized by a higher level of probability. This zone is suitable for analyzing and identifying potential trade entry points. The entry points can be selected with the help of technical analysis within the selector trading methodology. In this case, imbalances act as an additional factor in favor of the trade. So naturally, most imbalances in the market represents an inefficiency in price, and therefore there is usually a good chance that the price will return to fill that imbalance in order to make the price efficient again. Now, I cannot guarantee that the price will always come back to fill the imbalance, but in most scenarios, the price will return to fill the imbalances that form in the market. Because it is a rule of nature that everything wants to come to rest or to be balanced. In the same way, the price also wants to remain in balance. So when an imbalance is created, the price tries to balance it, and the imbalance gap between the wicks of the neighboring candles acts as a price magnet. It means that as the liquidity fills, the price will close the imbalance. This is what we call as mitigation in smart money concepts. Or when we say that the price has mitigated the imbalance, it means the imbalance has been filled and efficient price action has been restored, and the market will most likely continue in the direction of the impulse move. But do keep in mind that mitigation is more a general term, which can be used to indicate a filling of a price gap, filling of an order block, etc. We will talk about this topic in more detail in the upcoming episodes of this course. As you are aware by now, imbalances represent price inefficiency. Therefore, there is a high probability that the market will come back to fill the imbalance. For example, if a large bidder has manipulated the market, a correction might occur afterwards. Typically, price tends to mitigate the imbalance or the area from which it originated. Therefore, we can look to take a trade in the direction of the imbalance in order to profit from the price movement. In this way, we will be able to buy low and sell high like the institutions. However, there are times when the price will just continue to push back against the imbalance that are forming in the market. I won't go deeper into the trading aspects of this concept in this video. We will discuss different SMC trading techniques once we have covered all the basic concepts that guides the SMC theory. Now, I want to talk about some advanced concepts regarding fair value gaps. I won't force you to learn this, but it is worth knowing